Hello, everyone. Today on the Final Bar, I'm joined by Jeff Huge from JWH Investments in Minneapolis. We'll talk about this overall market environment and one particular asset class, probably not one that we've been thinking about too often on the upside, with some upside potential. We'll also talk about the overall conditions with the S&P stocks finishing the day up fairly strong, with the S&P up about 1.7%. Materials, stocks like FCX accelerating to the upside. What does this mean for the overall conditions and a potential rally through year end? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets using the power of stock charts, using data visualization techniques, technical indicators, behavioral finance, all the different tools we can bring to bear to understand investor psychology and really focus on trends and how they're evolving. I was taught there are three things we are trying to do as investors. Number one, identify trends. Number two, follow those trends. Number three, anticipate when those trends are exhausted. And it's interesting where we have sort of this choppy rotational sort of period here, August, September into October. We've certainly seen a rotation short-term, long-term uptrend and arguably still there, but showing some short-term deterioration. Seasonally, we're in the seasonally weakest part of the year, but that means we're actually nearing what is usually thought of as the seasonally strongest part of the year. November, December kind of going on. This is when stocks tend to do fairly well going through year end. So what signs can we put together helping us understand that trajectory from short-term pullback to a potential renewal of the long-term trend? What items would we see that would help us make sense of that future path? We have great guests on the show. I'm excited to talk with Jeff Huge here in a few moments. He really knows the markets well, always brings some charts to help us think. Next week, on Tuesday the 19th, we have Katie Stockton from Fairlead Strategies. On Wednesday the 20th, Mish Schneider, co-founder of Market Gauge and host of Mish's Market Minute on StockCharts TV. On Thursday the 21st, Craig Johnson from Piper Sandler in Minneapolis. Then the week after, on October 26th, we have Roman Bogomazov from Wyckoff Analytics in San Francisco. A couple of special events to let you know about. We just earlier today, just a couple hours ago, recorded a follow-up to our Chart Madness special. We did a special called Chart Madness back in March. We revisited with the same group of people, Greg Schnell, Tom Boley, Grayson Rose, and I, picked brackets of 16 stocks and picked our potential winners. We revisit our brackets, talk about lessons learned, and what stocks we think are best suited for the end of the year. Go to StockCharts.com/chartmadness for that special event coming up tomorrow, 9 a.m. Eastern on StockCharts TV. Also, to let you know, ChartFest 2021, we are excited to partner with our friends at Earnings Beats. Tom Boley is a name, a voice, and a face probably familiar to many of you who's hosted content on StockCharts TV for so long, does a great job of illuminating the markets. We are going to be doing an event with him on Saturday the 16th. Tom Boley will be there. Also, Grayson Rose from StockCharts, myself from StockCharts as well. We'll be talking through some of our routines and how we follow the markets every day, every week to try to better understand market dynamics. Go to StockCharts.com/ChartFest 2021 for more info on that free event. Also, last one is next week on Tuesday the 19th, my next webcast with Market Misbehavior called Buy in October, 5 Charts to Follow. Will be coming up Tuesday, October 19th. 1:00 p.m. Eastern. You can go to marketmisbehavior.com/October to sign up for that free event. So a lot of great content, not just on this show, but elsewhere to help you make sense of this market. Again, I think it's a vital time to try to understand the dynamics and position yourself well between now and year end. Let's continue on today with a market recap. So as I mentioned, the S&P overall showing signs of strength, and arguably the signs of strength really started yesterday. If you look at, sort of the first hour of yesterday's trading, you take that off. From there on, it's pretty much been a slow and steady acceleration to the upside. And we had a series of stocks reporting earnings and plenty of stocks that are actually pushing pretty strongly to the upside. Some energy names like Apache, APA, up in a pretty big way. Some banks, things like Bank of America, and others. But across the board, you have materials number one, technology number two, both up over 2% today. The laggers, the least well-performing stocks in the consumer space, still up over 1% today. So overall, certainly a bounce higher. And I think, as always, it's a question of how do you connect the short-term movements, one day's trading, with the long-term trend. So I think when we look at a chart of the S&P, hopefully it helps us make sense of how we determine when a short-term bounce becomes something longer and more meaningful that we want to pay attention to. Worth noting today, mid caps were actually almost identical to the large cap index. The small caps actually underperformed just a bit, but still up 1.2% using the S&P 600. The Nasdaq actually outperformed the S&P, the Nasdaq 100. That is a little more weight toward the mega cap tech and consumer trade. The VIX actually below 17. Now, this is coming from the low mid-20s not too long ago. It continues to come down as stocks bouncing. Volatility is decreasing, and the VIX is back below 17, around 16.9. Interest rates coming off today, and so you saw a choppy, move yesterday. They were closed on bond markets were closed on Monday, so it was a shortened week. But really, through the course of this week, we're seeing a bit of a rotation lower in rates, with 10-year yields nearing that 150 level. We've talked about 150 to 175. That was the range that we established earlier in the year. We've come back into that range. I would be very interested to see if 150 holds, because that's the lower end of that range that I think is a reasonable expectation here going forward. Let's see where else we can go. In commodities, we're seeing renewed strength from gold. It's interesting. Gold has been one of the most consistent underperformers, to be honest with you. If you look, year to date, it's been a pretty tough chart, but certainly potentially showing some signs of strength. I think by talking to my guest here in a bit, Jeff Hughes, would be interested to hear his take on the gold space. So I'll hold off a bit, but overall commodities as a whole in the green and showing strength. Energy, however, even with oil prices a little higher, energy a little bit higher, but underperforming some of the other sectors we mentioned already. Cryptocurrencies, if there is one adjective that I think pretty consistently describes most coins that I would show you, is volatile and choppy. However, it's all about the path of least resistance, the overall trend. Yesterday you saw Bitcoin really pushing to the upside through the course of the day. Today was sort of the digestion day. If yesterday was the big meal, today was sort of where we take our time and digest those recent gains. Ethereum on the other side, Ether really moving to the upside over the last 40 hours and continuing this slow and steady climb from just above 3,400 about a day and a half ago to touching 3,800 just before we're shooting this show live here after 4 o'clock Eastern. Let's look at a chart of the S&P 500 earlier. This is my chart, and I feel like I need to apologize. These charts become busier and busier the more the time goes by, and I apologize a little bit, but not much. I try to keep the charts super clean when we show them on the air, but I always remind people when you're actually using charts in your own work, I would not treat them as a painting you would hang on the wall. Treat them as a living, breathing discussion with the markets, right? This is the way where you capture your thinking. This is where you identify key levels and key signals that are important to you. Use the annotations tools and text tools to save and think about what you're seeing and what you're thinking. And I look at the S&P over the last 2 months, there's been this clear rotation from uptrend to downtrend depending on your time frame. And I think when you think of a short-term time frame, a tactical time frame, there's been a clear rotation from higher highs to lower highs, from higher lows to lower lows. That's potentially starting to change a little bit in this week, especially where you saw the pullback and today's gap higher with a close up near the highs of the day, getting just above the 50-day moving average, by the way. So for the last month, we've been, for the most part, below the 50-day. The last time we bounced just above the 50-day, we spent about a day above there before we rotated back lower. I would be very interested to see now going through the remainder of this week, tomorrow, and then into next week, are we able to hold the 50-day? That would be one certainly interesting indication that would suggest we're starting to see some further upside potential. Also, the RSI, right? The momentum overall has been relatively weak over the last month. You compare that to what the RSI looked like through most of 2021, where it remains above 40 on any sort of pullback, often becomes overbought on the big moves higher. That's kind of different now, right? You're sort of bouncing up and failing around 50 to 60, and you're sort of in the lower half of that range for the most part. Now we're actually breaking out of where we've been. The S&P testing its 50-day. I think tomorrow is really clear, or could be a clear indication of whether that is a sustainable bounce or not. And I think that's what I would be looking for on the chart of the S&P. I mentioned earlier we were recording our special event, Chart Madness Revisited. Again, we'll broadcast that tomorrow morning, 9 a.m. Eastern. But a couple of things we talked about, we're talking about this overall environment, and certainly this year, from March to October has been choppy. There have been a number of just different regime changes, right? In terms of growth versus value, in terms of, technology outperforming or underperforming, and a lot of other things, interest rate movements, so many different themes to try and tease out that in some small way or large way explain what's happening with stocks. But two ratios that came up in the discussion that I wanted to highlight. One is the ratio of financials to technology. Some of the stocks we had in our bracket of stocks to pick were things like Travelers, TRV, JP Morgan, JPM, but we also had some technology names. We had Microsoft, we had semiconductor names like NVIDIA and Intel were both on the list. And when you're thinking about this ratio, this is the ratio of the XLF to the XLK. If this line's going higher, financials are outperforming technology. If the line's going lower, financials underperforming technology, or technology outperforming. And if you look at this over many years, the line fairly consistently kind of just goes down because financials in general have been consistently underperforming the technology sector. That changed in a big way last September. This is when the S&P sort of was in a congestion range and broke out of that to the upside. You see the ratio in this case rotates higher. This is as the cyclical stocks were really improving in the first 5 months of the year. From there, settled back down just this week or last week or two. The ratio is potentially breaking to a new swing high here. It's down a bit today, but I'd be very interested to see if that pattern of higher highs and higher lows continues. Does that ratio continue higher? Because I think that is a scenario a lot of people are probably not looking for. We don't have time for the other one, but the other one's the copper to gold ratio, which is an interesting one to look into. We'll see if we have time for that a little later in the show. We need to take a quick commercial break. We'll be back with my guest, Jeff Huge. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the market environment using the power of technical analysis, the power of stock charts. A couple quick announcements before we get to today's guest, Jeff Huge. First off, we love to hear your questions that come up as you're analyzing your own charts, questions on how to use the stock charts platform, technical indicators and approaches, market history, market dynamics, whatever it is. We're happy to point you in the right direction. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Just put a comment below the video you're watching on our Stock Charts channel. We'd love to hear from you. Hope to answer one of your questions live on the air on tomorrow's show on Friday. Also, go to stockchartstv.com. You can use your email address, set up a free account, start watching all of our great content, special events like Chart Madness Revisited, The Pitch. It's great guests like Jeff Huge and many others, and fantastic shows that we have every trading day. Go to stockchartstv.com, or on your mobile device, just go to any of the app stores and search for Stock Charts TV on demand. I'm going to welcome on today's guest, Jeff Huge. Jeff is the founder of JWH Investments based in the Minneapolis area. He's been on the show a number of times, always brings some great long-term charts to help us make sense of what's happening around us. Jeff, welcome back to the show.
Great to be here, Dave.
It's good to see you. So we start with the S&P 500, and this is a chart I know we've brought up on some of your previous visits, and it's so interesting. There's this cyclical nature to what the market has been doing and sort of these decision points, right, in terms of where we're headed. Talk us through your chart of the S&P here.
Yeah, we're at another decision point since you put it that way. The last couple of times that we discussed this chart, it was a similar situation where we had, put in a definitive high and a definitive low, and the market was wrestling with itself to decide which direction it wanted to break. So something of a binary outcome. And once it did, it was clear that we could project an upside target. I think back in October of 2020, we suggested 4,000 as an upside target. The market decided to break to the upside, and we pretty much got there, got to about 39.50, and then we got into another consolidation. And these consolidations really established a pretty well-defined trend channel from those points, highs and lows in the past. And that trend channel has now been violated. That prior breakout projected to about 4,600, we got to 45.45 on an intraday high. 45.37 was the closing high. And now we're kind of in that defined range again. The difference this time, though, is we have a clear trend line break. We've also put in a lower swing low, at least going back to the August lows. And, from my perspective, the loss of the 50-day moving average was pretty important in terms of, establishing what was different this time. Now, I realize we recovered it today, but, before we get too excited, let's realize that that's just a 61.8% retracement of the entire decline at this point. And that's a pretty common level to expect the market to rally back to.
A really good point, and I love the simplicity of how you're laying out this trend. I hadn't really thought of it in this way. You feel how the pace of the market is sort of shifted, but you can really see it visually here with the chart of the S&P. It's a great chart to make sense of it. Your second one I had mentioned in the introduction, talking about gold, precious metals, which overall have been sort of a challenging space, but you see materials leading to on the way higher. What's your take on gold here?
Well, from my perspective, gold has been trading counter trend to the S&P 500. Really, if we go all the way back to August of last year, and the market has continued to move higher, and gold has been moving lower up until the last 3 months. Gold has stabilized. We actually upgraded gold with a bullish outlook last month, September 1st. And it left us standing at the altar, as you can see. Now, we're willing to give it a second chance here because it held that prior low, more or less. And if you look at the bottom panel of this chart, this is a structural momentum study. And what I'm seeing here is a positive divergence at the bottom. And that positive divergence gives me some confidence that we found at least a tradable low here. I also like the fact that we're breaking out above that downtrend line. Now, what that model really is illustrating is a distance or convergence divergence from the 50-day exponential moving average. And so now we're moving back above that level. And, if we continue to move higher, it will represent a pretty clear momentum breakout. And as you well know, momentum tends to lead price. So, we like gold above 1837. We would wait for a convincing daily close above that level. And quite frankly, I'd rather see it close above 1845, which is the anchored VWAP. Once we got through that, it would give me a lot of confidence that we've overcome that base and resolved to the upside. And as price begins to move higher, then I think we can project all the way up to about 2,500 on the gold. Like the S&P, again, I'm a breakout buyer, right? So, when things break out, you get above a level of resistance where there's no more supply, there's no natural sellers, but there's a lot of natural buyers as shorts are forced to cover. And that can really fuel the rally.
A great take, Jeff, and I love how you actually laid out with both of these. It's all about having a breakout, right? And you mentioned, I know your approach is really, built on breaking out some of these key levels. I can't disagree with you. I see the point. I'd not really thought about the momentum divergence. It's actually a really interesting take. We only have about a minute left, Jeff, but when you're thinking between now and year end, right now in the last month or so, we're in that seasonally weakest part of the year, September, October. Kind of feels natural that the market's kind of pulling back a little bit here. May not be done. We'll have to see how things play out. But when you think about the remainder of the year, going into November and December, which things in general often tend to start to improve, where are you looking opportunistically? Can you give us a group or general theme that you would think makes sense thinking about the next couple months or so?
Well, I would point to financials and energy as being relative strength leadership right now. I'm especially interested in financials, especially if rates continue to push above that kind of 150 level. I think a breakout above 150, if it's sustained, could take the 10-year treasury yield to around 2%. And that would definitely benefit financials fundamentally, and therefore I think price will follow. With energy, it's been terrific leadership the last couple of weeks. It might be a little bit ahead of itself, but I'll follow price. I'm a trend follower, right? So I'd rather let price be the final arbiter of value there.
I love it. When in doubt, let's follow price, right? Jeff, listen, it's awesome to have you on as always. I appreciate how you talk through the charts and help us make sense of things. Stay safe, be well. We'll talk to you again soon.
Thanks, Dave.
That's Jeff Hughes. Jeff's the founder of JWH Investments, based in the Minneapolis area. And his chart of gold is actually really interesting. We've talked about gold before, and I love that idea where you really focus on the follow through. That's one thing that gold has been unable to do. It's had a couple bounces in the last couple of months, but really hasn't been able to get above those previous swing highs. Think about what that would look like if it finally does. It starts getting above trendline resistance, starts moving higher. Talk about a trade I don't feel like a lot of people in. The long gold trade feels like an interesting one. I'm always interested to think about themes that I think are underappreciated in the market. Great take there from Jeff Hughes. Let's continue on, and our next segment is called Getting Sentimental. Let's focus on sentiment readings and what we can make sense using those, and really sentiment data in general. It has a couple different categories. Things like volatility in the forms of VIX and options data. I would group sort of the general options indicators, things like the VIX, the put call ratios would be in there too. And then you have survey data, things like the AAII survey, Investors Intelligence, Market Vein are all different surveys that I've paid attention to at times in my career. And then that third bucket would be positioning data, things like the name exposure index or the RIDEX flows, which shows you where the capital is actually flowing. And I think the three of those sort of buckets together can help you tell an interesting story about the overall environment. We'll start with the VIX, and this chart list that we're going to use is my sentiment indicator chart list. If you want access to this as a StockCharts member, you all are free to access it. The way you do it, by the way, is go to your dashboard. That's your homepage, your market dashboard. Go down to your chart list, and at the very bottom of your chart list, and I have way too many, I got to clean these up here at some point. I feel like every show I do, I all of a sudden start adding more chart lists. Here at the way bottom, there's this gray button that says Manage Chart Packs. Click there. You'll see a list that's called David Keller's Morning Coffee Routine or something kind of like that. This chart list and most of the charts we use on the show are all part of that list or all that chart pack. So the VIX, I think, in some ways is very cleverly referred to as the fear index. I think in some ways it's to its own detriment or to the detriment of the investor because it's not a true measure of fear. Like let's be clear, it is a measure of volatility. And while we think when the markets sell off, that tends to be increasing volatility in general, that is totally fair. But just remember, it is not the chart of the S&P plotted inversely. It's not a perfect inverse correlation. Meaning there will be times, particularly on a short-term time frame or even on a long-term time frame, where the market can go higher on increasing momentum, and the market can go lower on decreasing momentum because they're again looking at different things. Sort of mid-April to late April of this year is a good example where the market was actually going higher, and while volatility overall was relatively low, the VIX was actually going higher. So you had a strong positive correlation between the two over that couple-week period. So I would always caution you to think that it is a perfect inverse relationship. However, I think, when I look at the markets, I think of it in terms of change of character. When do conditions evolve? And I think if you look at June, July, August, you had one set of circumstances, right? The market going higher every second or third week, or if you look at the cycle, it's about a 4-week cycle where the market would pull back, the VIX would spike above 20. That's the buyable low. We rotate to new highs. It happened again in July. The pullback, the VIX above 20, the market pops higher and the VIX comes down. The same thing happens again in August. In September, that changed. Not only did we just get above 20, we went well above it. We went up to almost 26. We're nearer the highs for the year. Really spiked higher in January, up in the 30s. But since then, is one of the highest readings in the last 6 months for sure. From there, overall, the VIX has remained elevated. And the 50-day moving average of the VIX is this blue line here, and you can see how overall relatively flat, but now starting to go higher. And so it's indicating this sort of increasing volatility environment, overall elevated volatility. What's happened now, though, stocks bouncing higher, the VIX coming off. And I think the story of a market downturn, I think a further deterioration from here would probably most likely be marked by elevated uncertainty, by elevated fear. And I think this VIX going higher would certainly be a confirmation, particularly the VIX remaining above 20 for any sustainable amount of time. That would suggest to me that there's probably a deeper change of character and new lows below what we saw in early October could certainly be the case. The AAII survey, I actually haven't updated these horizontal lines, so I'm going to annotate as we talk here, but I usually put these lines on here just to visually show where we're at. So sort of an interesting spike this week. Up until this week, if you look at last week, it's been net negative, meaning bears outweighing bulls for quite some time. And so the green bar here at the bottom represents the bullish sentiment or the bullish votes. The red bars represent the bearish votes, and then the histogram at the bottom is the spread between bullish to bearish. So above zero, bulls outweigh bears, which is where we're at today. Last week and the last 4 weeks before this, we've had bears outweighing bulls. So it's actually gone back net positive, and it's sort of the bounce this week where actually you're seeing a pretty decent jump in bullishness from around 25% to 37, 38%. Here just in 5 trading days. What's interesting about this, I think the trend in the market has been marked by sentiment going higher. And I think the fact that the peak in the bullish sentiment was back here in April tells you a lot of what you need to know about the deterioration in breadth in sentiment characteristics while the market has gone higher over the last 6 months. However, you're actually seeing an interesting spike today. What's worth noting is this is still, even with the spike today, kind of mid-range for a bull market phase. This is not by any means euphoric over 50. This is certainly not one of the lower readings that we've had. Those are down in the 20s or even 20% or so is usually the lowest that we've been in. So we're coming off some of the lower readings, bouncing up a little bit given the strength in stocks today. I think the bull case for stocks, I would argue, would involve bullish sentiment increasing and showing that people are more and more actually starting to believe that there's a sustainable run to be had from the S&P. This one is the name exposure index. Those are the histograms in black at the bottom. You can see the current value around 64.50. Again, sort of mid-range where we've been at over the last couple of years, to be honest with you. This is certainly not on the lower side and certainly not on the higher side. Euphoric readings from the name exposure index are when this gets above 100%, which implies that the money managers responding to the poll are net leveraged long, right? It's over, basically on average, we're over 100% long. We're nowhere near that, which basically what this tells you is even though the market has bounced higher in the last week or two overall, the money managers in this poll are certainly not on board with the bounce here. They're still more defensively positioned overall. The Ridex flows have come off, or actually have increased, but coming off visually from some of the highest points on the chart here, but overall still very, very low relative to where they've been, which suggests in using the Ridex family of funds, investors are still very much bulled up in their overall positioning. That is our quick look at sentiment, hitting on some of the key indications on volatility, survey data, and positioning data. We need to wrap today's show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1, the copper to gold ratio. As I mentioned in our special Chart Madness Revisited, which is coming up tomorrow, we had a great discussion about a lot of different stocks and just the exercise of stock picking and how to manage risk over time, manage risk using charts. And one of the ratios we talked about as we were talking about the overall environment was copper versus gold. Jeff Hughes, I thought, did a great job talking about the bull case for gold, and I don't disagree with him. Getting above those swing highs, or above 1845, I think he was saying on a closing basis, would get us above those highs from the last couple months. I think that makes a ton of sense. I'm concerned we just haven't been able to do it yet, and until that happens, the chart is still overall in a negative trend. Compare that with the chart of copper, which is actually really starting to improve. And Greg Schnell on the special, as you'll hear when you watch tomorrow, very much bullish on gold and on copper and copper related stocks. We see FCX rallying just fine today. Overall, this ratio is rotating higher. And in general, copper versus gold is a general indicator of economic strength. In strong times, copper tends to outperform gold, and it's certainly showing increased demand for copper. Chart number 2, I mentioned materials, the number 1 sector today. FCX potentially rotating very nicely above trendline resistance. So in the last week, FCX has found support, and in the last couple of weeks, found support at the 38.2% retracement level using the March 2020 low and the May 2021 high. Look at those beautiful bounces off the 38.2% retracement level, now breaking back above trendline resistance, breaking above previous swing highs, breaking above their moving averages, RSI breaking above 60, and the trend line using relative strength actually being broken as well. All of those signs indicate a rotation from downtrend to uptrend. Pretty constructive setup for FCX. Finally, where it is not quite a constructive setup yet, but bouncing the short term, the ARK Innovation Fund. We had a lot of discussion earlier today about Tesla and how that relates to some of the other stocks. The challenge with the ARK Innovation Fund is a lack of follow through. So just like Jeff was talking about a breakout for gold, and that indicating renewed strength, I would love to see the same thing on something like ARKK, breaking above the highs around 130. That's the high from March, April, and July. I would need to see that to feel confident about renewed strength for the ARK Innovation Fund. Folks, that's our show for today. Special thank you to Jeff Hughes, joining us from JWH Investments in Minneapolis. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.